Add up every unit of money that exists on this planet. And how much is there? Counting cash and deposits together, the total comes to roughly $98 trillion. But the real question today is not how much money there is. It is where that staggering pile of money is flowing right now. You hear the same lines everywhere. Money is fleeing American stocks and running into gold, or money is pouring into the Korean market. And those lines are half wrong. Money does not vanish, and it does not migrate wholesale from one market into another. The world's money behaves like an ocean. The total volume stays the same, and it simply changes where it sits. What changes is not the quantity of money, but the price tag attached to each asset. If you miss that distinction, you will be jerked around forever by headlines about money pouring in and money running out. Understand how the current actually works, though, and you start to see where the big money is headed next. In 2026, the Korean stock market is exactly where that current came crashing down. Its total market value doubled in a single year, overtaking India and the United Kingdom to become the sixth largest market in the world. And none of this is somebody else's story. Your pension, your American stocks, your position in Korea, all of it floats on this one enormous current. So let us unfold the map of where the world's money flows, one sheet at a time. First, let us pin down properly how much money actually exists in the world. Money comes in types. The cash in your wallet and the balance you can spend today are what economists call narrow money. And that comes to about $50 trillion. Add time deposits and savings accounts on top, and you get broad money, known in the trade as M2, at roughly $98 trillion. Put simply, that is every cash-like asset held by every person on Earth, added together. And here is the astonishing part. Of all that money, actual notes and coins, the real cash you can hold in your hand, amount to less than $9 trillion. That is under 1/10 of the total. The other 90% and more exists purely as numbers inside bank computers, which means money is mostly not a physical thing at all, but an electronic record that runs on trust. So who decides how much of it there is? The central banks of each country. The Federal Reserve in America, the European Central Bank, the People's Bank of China. When they release money, when they open the tap, the world's money supply grows. That state, where money is plentiful, is what people mean by abundant liquidity. Close the tap, and money dries up. Liquidity is the seawater itself, the force that lifts every asset price and drags it back down, the tide coming in and going out. So if you want to read the flow of money, you first have to see whether that water is rising or draining right now. So where does all this money go and sit? Let us draw the map of assets, the containers that hold the world's wealth. The biggest seat, surprisingly, is not stocks but real estate. Global property is worth about $393 trillion, an overwhelming number one. Next come bonds, the debt paper issued by governments and companies, at roughly $144 trillion. And already an important fact falls out of that. Stocks, the thing we stare at every single day, are worth about $126 trillion, which is smaller than bonds. Retail investors watch only equities, but the money of the truly big players, the pension funds and the insurers, is mostly submerged in that vast ocean of bonds. Gold comes to about $20 trillion, and every crypto coin on Earth, Bitcoin included, adds up to only around $3 trillion. In proportion, real estate is more than half, stocks are a fifth, gold is 3%, and crypto is less than 1%. And now we have to talk about the single most important idea in this whole video. These numbers are not piles of money. They are nothing more than price tags. Let me give you an example. Picture a company with 1 billion shares outstanding. Today, exactly one of those shares changed hands $1 higher than yesterday. Instantly, the price tag on all the other shares is marked up by that same dollar. The money that actually moved was $1, and yet the market value on the book swells by a full billion. That is the heart of it. When market capitalization rises, it absolutely does not mean that an equivalent amount of money came in from somewhere. It is simply a revalued number, every share recalculated at the very last price that traded. And there is one more myth here that fools almost everybody. It is the idea that cash sits waiting outside the stock market, ready to flood into shares. That is flatly impossible. When I buy a stock, my cash does not disappear. It passes straight to the person who sold the stock to me. Across the market as a whole, not 1 cent of cash goes in or comes out. So even if the index doubles, the pile of money waiting on the sidelines does not shrink by a single dollar. What moved was never the money, it was the price tag. Now let us go deeper inside the seat called equities. That $126 trillion world stock market is anything but equal. The United States alone takes 48% of it, close to half, or about $75 trillion. America on its own is bigger than the next 9 largest countries combined. China, in second place, is worth about $15 trillion, which makes the United States 5 times its size. So where does Korea sit? At roughly $5 trillion, it is a little over 3% of the entire world. Compared with America, that is a small market, 1/15 the size. And it was in that small market that something extraordinary happened in 2026. The Korean stock market leapt to 6th in the world, passing India and then the United Kingdom. Here we have to look at a hidden mechanism that explains why America grew this enormous. It is the index fund, the style of investing that buys an entire market in one go. These days, huge numbers of people put their money not into individual stocks, but into index funds that hold the whole market. And those funds do not care in the slightest whether a stock is cheap or expensive. They simply buy, mechanically, in order of market capitalization. Put plainly, it is a machine that funnels the most money into the biggest and most expensive stocks that already exist. So the giants just keep getting more gigantic. That concentration is why America became half the world, and why the Korean rally was driven by exactly two stocks, Samsung Electronics and SK Hynix. The trouble is that the same concentration works just as powerfully in reverse. When money drains out, the stocks that rose the most are the first ones to collapse. So why, of all years, did that great current come pouring into Korea in 2026? The answer fits into a single word: semiconductors. More precisely, the memory chip supercycle that artificial intelligence set off. Running an artificial intelligence like ChatGPT demands a staggering quantity of memory chips, and only a handful of companies on Earth can actually make high-performance memory of that grade. With Korea's SK Hynix and Samsung Electronics sitting right at the top, demand exploded while supply could not keep up, so prices shot upward and profits ballooned. That fed straight through into share prices. SK Hynix stock rose tenfold in a single year, and Samsung Electronics climbed close to fivefold. And exactly as we learned earlier, the price tags on those two stocks were revalued, and the entire market value of Korea doubled. Several forces stacked on top of each other here. The first was genuine earnings. Chipmakers really did start making far more money. The second was expectation, which the market calls valuation. Valuation is simply how many times the same profit investors are willing to pay for. And the more optimistic people feel about the future, the bigger that multiple grows. The third was liquidity. America happened to start cutting interest rates, which swelled the pool of money willing to take a risk and buy stocks. All three hit at once and lifted the Korean market. On the surface, it looks like a perfect rising tide. But hidden inside that beautiful picture is a frightening shadow that almost everybody misses. That shadow is the question of who, exactly, is holding this market up. Common sense says that if the Korean market doubled, foreign investors must have arrived carrying enormous sums of money. The truth is the exact opposite. Through 2026, foreigners were net sellers of Korean stocks, dumping $95 billion worth of them. The big money was walking out the door. So who on earth was buying this rising market? Retail investors, ordinary individuals. Korean retail investors bought more than $80 billion of stock and held the whole market up on their shoulders. Why is that such a frightening signal? Because a large share of that buying was done with debt, with borrowed money. Apply the market capitalization rule we learned earlier, and the picture turns genuinely chilling. What doubled that market was not some vast inflow of money, but a price revaluation created by leveraged retail buyers pushing at the margin. The truly big money, the foreigners, were actually pulling capital out. A structure like that rises fast, and it breaks far more violently. When prices fall and collateral loses value, shares bought with borrowed money get liquidated in a forced sale, a margin call. That forced selling drives prices lower still, which triggers the next round of margin calls, and the spiral feeds itself. In May 2026, fear about American interest rates spread, and the Kospi crashed almost 9% in a single day, a preview of exactly that. International research institutions are now warning about both sides of the Korean market at once: a dazzling boom, and the bubble crouching underneath it. So a rising tide is not something to celebrate blindly. You have to look at whose shoulders that water is resting on. So what is the valve that ultimately sets the direction of this enormous current? Two things: interest rates and the dollar. Start with rates. When interest rates rise, bank deposits and safe bonds begin to pay well. The reason to hold risky stocks shrinks. Money drains out of equities and gold and heads for cash and bonds, and the tide goes out. When rates fall, money bored with feeble interest goes hunting for higher returns, pouring into risk assets, emerging markets and gold, and the tide comes back in. But there is a deeper truth one level below that. What really creates the tides is not American interest rates themselves, but the value of the dollar. According to the Bank for International Settlements, hidden dollar debt that barely shows up on any balance sheet runs to a staggering $80 trillion. Banks and companies outside America borrow dollars and use them to buy assets all over the world. So when the dollar strengthens, everyone on Earth has to buy dollars at the same time to repay that debt, and the whole planet receives a margin call at once. In that moment, money drains out of emerging markets, out of gold and out of Korea, all together. That is why reading the big current means watching whether the dollar is strengthening or weakening, just as closely as you watch the Federal Reserve's rate decision. Finally, let us settle the question of gold. People usually believe gold is the asset that defends you when prices rise, and that is only half true. The real keys to the gold price are the real interest rate and trust in the dollar. The trigger came in 2022, when the West froze $320 billion of Russia's foreign exchange reserves in an instant. Central banks around the world watched that happen, understood that their own dollars could be seized at any moment, and from then on bought more than 1,000 tons of gold every year for 3 straight years. That is more than double the pace of the previous decade's average. The real reason gold smashed through its all-time high was never inflation. It was this quiet loss of faith in the age of the dollar. Now let us tie all of this into a single thread. The world's money never disappears. It only changes where it sits, according to the valves of interest rates and the dollar, repricing every asset's tag along the way. So where is the big money headed next? In the end, the dollar decides the direction. If America cuts rates further and the dollar weakens, money is likely to keep flowing into the places that were held down, into emerging markets, into gold, and into the Korean market. If inflation flares up again and America raises rates and the dollar strengthens, then the tide goes out and money drains from risk assets. And a market propped up on debt, like Korea's, is the most fragile thing standing when that tide pulls back. So the thing to watch is not the Kospi index itself, but the direction of the dollar and of interest rates floating above it. Let me leave you with the most important truth of all. When a real crisis hits, money does not move into safe assets. In a crash, stocks and bonds and gold and crypto all collapse together, strange as that sounds. The only things that go up in that moment are cash, the dollar, and ultra-short-term government bills. In the instant of crisis, money does not travel somewhere else. It gives up being an asset at all and curls into cash. That is why a wise investor, when the tide is coming in, does not borrow and dive in after the crowd, but always keeps a life jacket of cash on hand. Reading the map of money comes down to one humble act: judging whether the tide right now is coming in or going out. If you want to trace these great currents with me every week, hit subscribe and come along.